Welcome back to Wealth Signal. I'm Alex Carter, and what I'm about to show you today might be the most important trade setup hiding in plain sight right now. The most hated stock in the market right now just flashed a signal, and if history is any guide, missing it could cost you. I'm not talking about some obscure penny stock. I'm talking about a company with 3.4 billion monthly active users, a company that prints cash, a company Wall Street has decided to punish, simply because it's spending big on the future. That company is Meta. And today, we're going to look at exactly why the market is wrong about it.
Meta is down. Still nearly flat over the last 12 months. Still hated. Still misunderstood. But here's the thing about hated stocks. When the crowd finally comes around, you don't want to be the one who was watching from the sidelines.
Before we dive in, if you're serious about building real wealth and staying ahead of the market, hit that subscribe button right now. We drop videos like this every single day.
Today we're going to cover three things. First, the market context. What's happening with Snowflake and Salesforce tells us something important about where software and AI are heading. Second, the real Meta story. Why the hype is wrong, why the fear is wrong, and what the numbers actually show. And third, a DCF breakdown that might surprise you. Let's start with what happened in the market this week, because it sets the stage perfectly for what we're about to talk about with Meta. Snowflake just reported earnings. The stock jumped over 30%, from $175 to $240. And the reason is simple. They beat across the board. Product revenue beat estimates by 4.7%. EBIT beat by 38%. Guidance came in better than expected on every single metric. But here's what matters most. Snowflake proved something the market desperately needed to hear. AI is not killing their business. AI is accelerating it. Snowflake partnered with Amazon AWS and OpenAI, and the results showed exactly what happens when a cloud data company gets the AI narrative right. Now Salesforce. Different story entirely. Salesforce reported the same week. Stock? Basically flat. And here's the lesson. They're buying back an extraordinary amount of shares, $27 billion in a single quarter. That's not a typo. $27 billion of buybacks in one quarter. And yet the market yawned. Why? Because the business model is different. Salesforce runs on a seat-based model. Snowflake runs on consumption. And right now, in the AI era, the market is rewarding companies that grow with usage, not companies that grow by selling more seats. Agentforce, Salesforce's AI product, showed 205% year-over-year growth. But it's still too small to move the needle on a company doing $11 billion per quarter. The message? Good company. Broken stock. For now.
Quick question before we move on. Are you currently holding any software or cloud stocks? Drop a comment below. I'd love to know what's in your portfolio right now.
Meta. The real story. Now let's talk about the elephant in the room. Meta. If you've been watching this channel, you know we've been saying this for a while. Meta is the Google of 2025. It's a cheap company that is growing fast, and the market keeps punishing it for one reason. Capex. Meta is spending enormous amounts on AI infrastructure, tens of billions per year, and the crowd keeps asking the same question. What's the return on that investment? Here's the answer they keep missing. The return is already happening. AI is improving Meta's ad targeting. It's reducing the cost of creating content on Instagram and Facebook. It's making Meta's platforms more engaging, which means more time on app, which means more ad inventory, which means more revenue. You don't need to wait for a cloud product to justify the spending. The core business is already eating the returns. Every week, quietly, without headlines. But here's where it gets interesting. Zuckerberg has said, publicly, in shareholder meetings, that almost every week companies come to Meta asking for two things:
either an API service or compute they can buy at a premium. Meta keeps saying no, because they need the compute for their own business. But that option exists, and the day Meta says yes, watch what happens to the stock. Now, let's talk subscriptions, because this is a lever most people are completely sleeping on. Meta just launched subscription plans: Instagram Plus, Facebook, WhatsApp, Meta AI Plus at $8 per month, Meta AI Premium at $20 per month. People laughed at the idea, but here's the math. Snapchat, an inferior platform by any metric, has over 25 million paying Snapchat Plus subscribers. That's 2.6% of their monthly active users, and that's generating over $1 billion per year in high-margin revenue. From Snapchat, Meta has 3.4 billion monthly active users. If Meta converts the same 2.6% of its user base, that's $4.5 billion in additional high-margin revenue annually, every year, without a single new user. If they hit 5%, that's closer to $10 billion per year. Find me another company that can pull a lever like that.
The DCF. What the numbers say.
Let's run the numbers, because the best argument for Meta isn't a feeling, it's math. Right now, Meta is trading at around $638 per share, market cap just over $1.6 trillion. For a company this size, growing this fast, that number is lower than it should be. Here's the base case DCF. Assume realistic revenue growth. Assume margins stay where they are. Assume the AI investments keep improving the core business. Not moonshots, just steady compounding. The base case points to roughly 35% upside from today's price. That means a fair value closer to $860. The bull case, where the AI infrastructure starts generating cloud revenue, where subscriptions scale, where llama models catch on commercially. That's 80% upside. Call it $1,150 per share. The bear case, where capex never pays off, where competition erodes margins, still shows only 14% downside. The floor on Meta isn't that far down. The ceiling is very far up. Now here's the but turn, because balanced thinking is how you make good decisions. Meta's capex is real. The spending is massive. And if the AI investments don't convert, either through better ad returns or subscriptions or eventually a cloud product, then the market's skepticism would be justified. There's also Llama 4. The release was underwhelming. The model didn't land the way Meta hoped. That's a setback. But MuArc, Meta's latest model, showed something much more promising. And if the next release builds on that, the narrative around Meta's AI capabilities starts to change fast. This is the riskiest element of the Meta thesis, not the spending, the model quality. Because without a great model, the subscriptions don't stick, the API doesn't get built, and the AI story falls flat. If you're finding this breakdown valuable, smash that like button right now. It genuinely helps more people find this content.
Let me bring this all together. The market is wrong about Meta, not because the spending is smart, maybe it is, maybe it isn't, but because the market is ignoring 4 separate revenue levers that none of Meta's competitors have at the same scale. 1. AI-improved ad targeting. Already working, already compounding. 2. 3.4 billion users ready for subscriptions. 3. A compute infrastructure that could become a cloud business overnight. 4. AI models that, if they get better, open an entirely new commercial market. Any one of those 4 could re-rate this stock significantly. All 4 together? The market hasn't even begun to price that in. The stock had a nice green candle yesterday. It's approaching its 100-day moving average. To close the earnings gap completely, it needs to get back to $665, $670. That's still near the 200-day. We're not there yet, but the direction has changed. The most hated name in the market is starting to move. The lesson here isn't just about Meta, it's about the pattern. The best opportunities in the market don't come with applause. They come when the crowd is loudest in the wrong direction. When everyone is screaming about capex and nobody is counting the levers. That's where the real money is made. Patience is not passive. It's a strategy. And right now, the patient investor in Meta is being set up for something interesting.
Do 3 things for me right now. First, smash that like button. It tells the algorithm this content is worth sharing. Second, subscribe and hit the bell so you never miss a breakdown like this. And third, drop a comment. Tell me, are you buying Meta here? Or are you waiting for a better entry? The debate in the comments is always the best part of this channel. I'm Alex Carter, and I'll see you in the next one.